US stocks are at a record high, and the US dollar is up today but down across the week and still remains close to its 3.5-year low as investors digest non-farm payroll data and look ahead to next week's events. I'm joined by StoneX Head of Global Content, John Kicklighter. Thank you for joining us, John.
Thanks for having me.
So, John, the non-farm payroll was stronger than expected, showing resilience in the US labor market as tariff worries are still not really showing through. What are your takeaways from this data point?
It's a complicating data point because it's not really a robust. The U.S. economy is on a breakaway tear kind of pace. It's just enough to up in the apple cart and make trouble for all the different themes that are across board. So it's a 54th month of growth in net payrolls. So that's a nice consistent trend post pandemic and recovery expansion. The pace is better than expected, but not to the point of where we're seeing an override of some of the other fundamental issues of slowdown that we've generally been warned about for months. And it's also a downtick in the unemployment rate. So that is going to be a reinforcement of the Fed's wait and see approach as they're concerned about the inflation pressures that are coming through potentially with tariffs, and for which President Trump has given Jerome Powell a lot of pressure, and Jerome Powell has been very consistent in his address of the policy after the last hold on rates, but also in his testimony before Congress last week. So it is. You could say it's a really good middle of the road figure, reinforcing, but in macro terms, it's actually very disruptive because it doesn't give a clear resolution to any of the major participants that are monitoring this kind of data point.
Now, looking ahead to next week, what are the general market conditions that we're expecting to be dealing with next week?
So the first consideration that I have looking at this as a analyst and trader is liquidity. All right. So obviously we're heading into the holiday weekend, which will have the US offline, and historically the globe tends to go online and just allow for the soft, quiet close to an early week take hold. So that thin liquidity is really considered more so about how will we recover from it. Are we going to just jump back into active markets with full participation come Monday, or is it going to carry over as a kind of stopgap week? And looking at the economic docket, we do have the capacity for really stirring the markets enough to pull people back in, and to perhaps put some traction to volatility. So try to foster some momentum and trend development, but it's not particularly easy to do given the market's acclimation to a lot of the uncertainties. They kind of like ride over the risks and kind of play down the benefits when the improvements are seen. And historically, we look at the performance of the S&P 500 and the VIX as kind of its performance and risk measure. Obviously, past performance not indicative of future returns, but the 28th week of the year generally is calm, quieter, and a positive lean. So, really leaning into those kind of conditions. So, it's going to be more so a focus on headlines versus economic data points. And it's going to have to be an overcome the inertia kind of situation.
And what do you think will be the most potent themes which we'll be watching, which could upend the calm for the bulls or the bears?
Sure. So, like the major macro themes, economic activity, even monetary policy, and the general trends, not just for the Fed, are probably going to take a back seat because they're only going to move incrementally. Even if we have some significant headlines that come out of the blue, you're not going to get it from the docket for sure. But you do have some very prominent interest, obviously, in tariffs. Now, the number one thing is the end of the 90-day reprieve from the reciprocal tariffs that the U.S. initially implemented back in early April. That is supposed to be on July the 9th. So, very, very pressing, but the market does not know whether it'll just be overlooked, extended, delayed, whether they will just reapply to everybody and walk it back as we did with the initial announcement of these tariffs. There is just a great degree of uncertainty and a wider berth of accepting these concerns, these uncertainties by the market. So it is going to be very interesting to see how the markets actually respond because of all the chaos and how these policies play out. The markets have just grown hardened to the risks that they can represent. Now, it doesn't mean that the markets have totally written it off and no longer are going to be concerned. They're just going to think that it's always going to be better. But I think of all the different scenarios I can consider, all tariffs back on, extend for another indefinite period. I think the most influential would be if they implement against certain countries that they think to be recalcitrant. So obviously, they've made some references to the European Union, they've made references to Japan. If they apply to certain countries and not other countries, that would insinuate a fixed and more direct concern, and that would probably be a more volatile response because it's going to be between certain countries in the United States. So that is going to be the top consideration, and there's no clarity about how the market would react. There's not even a black and white outcome, so it makes it very complicated with the spectrum of possibilities. Aside from that, I would continue to watch the dollar. As you said in the beginning, it is near that 3.5 year low, and the uncertainties that we have there, especially as the dollar is losing its haven status because of its Fed independence and the budget is exploding. And then at the same token, it still has a higher yield. So it's kind of how is it going to be perceived in this global perspective? But it still is the most heavily used currency in the world for transaction and reserves. So it still requires some adjustment one way or the other. So that's another theme that I'd watch very closely.
And as far as event risk is concerned, what is the top event risk next week that could spur these themes or kick off a new focus even?
So there is a lighter side of the economic docket. So I wouldn't be looking to the docket to really trigger any systemic moves. Certainly for localized volatility, for regional assets, or for particular benchmarks. But I wouldn't necessarily pinpoint something as being disproportionately capable. But that being said, I would say on Monday, watching data like the Chinese FX reserves is going to be very important. And I would pay attention to a New York Fed Reserve figure that they have that they update every month, which is the Global Supply Chain Pressure Index, which obviously that's a trade war consideration, and that's going to be a theme that's already on people's minds. Tuesday, we have an RBA rate decision, which is expected to result in a 25 basis point rate cut. So we want to see how that impacts one of the carry currencies, the high yield carry currencies, and one of the regional financial powerhouses of the APEC region. We're also going to get the Japanese Eco Watcher, so it's an economic sentiment survey, which is a good update for, again, a country that's going to be in the crosshairs of the United States with its trade policies. I would also watch Canadian manufacturing, and the US has both a NFIB business confidence figure. So for June, we want to see how they're taking trade wars and uncertainties and budgets and the projection of growth forecasts. And speaking of projections, we also have the New York Fed's inflation expectation figure for consumers. So that's going to be worthwhile. Wednesday is Chinese inflation. The RBNZ, the New Zealand Central Bank, is expected to cut by 25 basis points. The FOMC minutes, but it's really going to be headlines. It's going to be all focused on the tariffs and whether they are reimplemented or whatever the scenario is going to be. Thursday is just very lacking in meaningful data, so I wouldn't look at anything specifically on that day. And then Friday we rounded out with some carry through, some expectation of what is going to be the next week. The following week we're going to have Chinese GDP. We're going to have the start of U.S. earnings, but as a precursor to the Chinese GDP, we have Singapore's second quarter GDP reading, the advanced reading. So that kicks off our GDP run. We're also going to have UK GDP for the month. We have Canadian jobs. And even on Saturday, we have Chinese trade balance. Obviously, liquidity to be drained by then, but we will be definitely seeing that taken in by the macro watchers.
Excellent. Well, thank you very much for your analysis once again, John. Thank you.
Thank you.
For more videos like this, please do like and subscribe.